How to analyze stocks for beginners. Hello, everybody. This is StockerFinance. I'm your host, David Scheuer. Make sure to follow me on Twitter at StockerFinance for more information, or support the channel at patreon.com/StockerFinance. So, how to find stocks to analyze. Before we go ahead and get into the analysis strategies and how to analyze a stock, well, we need a stock to analyze. Some ways to find stocks to analyze are reading the news. Some news outlets that I really like include the Motley Fool. Yahoo Finance is decent as well. I try to stay away from some of the big mainstream media online like CNBC, since a lot of the stuff that they cover can be a little clickbaity at times. On top of that, it also just it lags behind a little bit. So something will happen and then they report on it a few days later, or they have some biases going on there as well. So just be careful when you read the news, but always do your own research and do your own analysis, which I'm about to teach you how to do. On top of that, you have YouTube. YouTube you got to be careful with as well, similar to reading the news. YouTube has a lot of misinformation out there. Almost no one on YouTube is actually licensed and has, the license to trade or a license to manage money or give out investment advice. So that is kind of dangerous there. But there are people who do give really good analysis of companies, of stocks, etc., and who do really great research for new stocks, for IPOs, etc. On top of that, we have Reddit. Reddit is a really simple place to find it. Again, same warning that goes along with reading the news and YouTube, but Wall Street Research, which is a subreddit that collects information and analysis of stocks from tons of other Reddits, and then it cross-posts it to that subreddit and does it automatically. So it's pretty cool. I've actually found some companies through that subreddit. They do some really good analysis there. Just a simple way to, get your toes in the water and potentially find a company that you can then go ahead and research. There's also word of mouth. I get told companies all the time. People ask me about this new company that's coming, IPOing, which is an initial public offering, which means it's going to be publicly traded on the markets. That's going to be doing that soon. There's a bunch of different people who will tell me stuff all the time through YouTube, Twitter, whatever it is. On top of that, you have stock scanners. A stock scanner is just a way to put in a bunch of information essentially, and then it'll give you a list of companies that meet that criteria. So you could say, I want the company to be worth less than $2 billion. I want the company to be trading at, between $20 a share and $100 a share, since whatever it might be, the situation that you're in there. You could say, I only want to look at consumer goods companies, or I only want to look at electric vehicle companies. So it's a way to kind of just narrow the playing field since there's so many companies to potentially invest in, and there's just so many public companies out there. And let's move on here though. Anyways, here are some analysis strategies. So there's three main strategies that cover the whole thing. And I don't even know if strategy is really the right word here, just a way to analyze a company. First, there's technical analysis. Now, technical analysis is the study of forecasting the direction of prices through studying market data and charts, most prominently by studying price fluctuations and volume. This is where you see the candlestick charts, where you see the people with 15 monitors, a huge chair, they got 3 keyboards, and a gaming headset on, and they've got tons of random stock charts. There's green numbers, red numbers flashing all over the place. You have no clue what they're doing. They're drawing random lines on the screen. That usually is technical analysis, and there's a lot of that on YouTube, but you really don't need that to analyze a company. Unless you are a super experienced day trader on Wall Street, it's usually not going to work out well for you at all, to be honest. Most people, there's a reason, I think it's like 90% of day traders lose money. In fact, most end up losing all their money that they invested. There's very few super successful day traders that actually made their money from simply using technical analysis. Now, anyways, we're not really going to focus on technical analysis in this video for those reasons. More importantly, though, is fundamental analysis. Fundamental analysis is what Warren Buffett, for example, what he uses. He studies the business's financial statements, the markets, their competitors, the business's health. So he wants to see is the market that this business is in, is it growing, is it shrinking? Are there competitors that are way ahead of them, or are they the big guy on top? Is the business healthy? Is the CEO cool? Is he doing a really good job? Are they making good products? Do you understand how the business operates? Are the financials good? Is the company beating earnings estimates? And is the company, growing its revenue and its net income? Are its margins healthy? You could go on, and we'll get into that a bit more in a second here. And then my last one, which I kind of conjured up this name myself, I called it social analysis. I don't know if that's a good name for this or not. Go ahead and come up with a better name if you can. But it's a study of consumers' way of thinking. So it's kind of a combination of microeconomics mixed with psychology. An example of this is the video game release going to be successful? Let's say we have a company that's publicly traded. They can make video games, and we go ahead and look at the technical analysis because they're about to release a video game. Well, that doesn't tell us anything about whether this video game is going to be successful or not. Technical analysis does not tell that. You can't find that out by just looking at stock charts. On top of this, we go ahead and look at fundamental analysis. Well, we could look at some historical data through fundamental analysis. Say, okay, they're releasing this video game in the winter, or they've released video games similar to this one. Maybe it's the third one in a series of video games, and they've historically done well. So we can kind of back up our theory with this and get an idea of how they're doing, but still does not tell us if this specific video game is going to be successful on release. Instead, we can use social analysis. And what you do is you go ahead and say, okay, let me talk to my friends. Let me go ahead and watch YouTube videos about this game. Try to get a copy of the game in my hand. If there's a beta version of it, I can play it for myself. See if it's actually a good game and really get to understand it. See if there's hype building up about it. Are tons of YouTubers doing reviews on this video game? Are they talking about it on TV, in the news? It's just, are words buzzing about the game? Does it seem like the momentum for this game is there and that when it gets released, it's going to have a successful release? And you can find that out through what I just described, which I called social analysis. And so that's just a little example there of how you can kind of use fundamental analysis as well as social analysis to decide whether, this video game release is going to be successful. And if the video game release is going to be successful and the fundamentals of the company are really solid, then you might want to consider this company as an investment in the future or currently, based on the fact that the video game release coming up you believe is going to be really solid, and the fact that even if the game does fail, well, the fundamentals of this company are super solid, that it has cash to rely on. It's still a growing company. It's got tons of other video games. Maybe it's got subsidiaries that are doing really well as well, and this is just one part of the business. So if the fundamentals are good, you can move on to social analysis, and if that checks out as well, you might want to consider it as an investment. Now let's go ahead and use an example here. This is exactly how I analyze stocks. It's really, really simple. First off, I find a company, whether it's through word of mouth, the news, whatever it might be, as I listed off earlier. And let's use AirCap Inc. as an example. I'm just choosing this company because I've done a couple analyses of this company on this channel, and those were pretty in-depth videos, and we're not going to go super in-depth since this video is for beginners. But we start off with just an overview of this company's stock. And a lot of beginners, a lot of people go ahead and focus all their attention on that green line there, the stock chart. And let me tell you, it is not necessary to do that. On top of that, they'll see the price and say, okay, it's $26.82 a share right now. It's a really cheap stock. That must mean they're not doing very good if their stock is trading so low. That does not mean anything. All that matters is the market cap, and you can look at the 52-week high, the 52-week low, and the PE ratio as well. But the specific stock price does not really matter. It does matter, I guess, if you can't use fractional shares for whatever reason, which means you buy a percentage of the current. So like you could buy like $5 instead of $26.82. They're offering that technology now, which is really cool. But that's not really the $26.82. I know I'm focusing on this a lot here, but the reason is a lot of people get that mixed up with valuing the company, and that's not how you value the company. The value of the company is the market cap, which you see in the lower left there. Below the market cap, and you see that the market cap is $3.48 billion. This is a multi-billion-dollar company. So it's nowhere near a small company just because its stock price is only trading for $26.82. It has millions, over 100 million shares out there trading, and it can keep releasing more shares, and it will keep releasing more shares over time, which will slowly dilute. And they can dilute the stock price. They could also go ahead, or dilute their shares. They could also go ahead and do a stock split. So if their stock was trading too high, they could do a stock split, like a 5-for-1, which will divide the stock price by 5. Doesn't change the market cap of the company. It just trades the price at which the shares are trading at, so that more people are able to afford buying the stock, which in a sense can also inflate the stock price through that, since there's more volume coming into it. Anyways, let's move on here to some simple stuff. We're looking at the PE ratio. The PE ratio is the price to earnings ratio, and it is 3.19. That's a super low price to earnings ratio. That means it's only trading 3 times earnings. If you look at some tech companies these days, there's companies that are trading for 400, 600 times earnings. Super absurd. And I like a lot of those companies. I'm not hating on them or saying they're bad investments necessarily, because their stocks are in really high demand and they're doing, their companies are doing very well, generally speaking. But on top of that, companies like this, where you look at the PE ratio and it's 3, it's almost trading exactly at its earnings. That's pretty low. That's a good sign, though, that perhaps this company is undervalued right now. An average P ratio is usually around 15 to 25, I would say. Then we look at the dividend yield. Now, a dividend is what is paid. A dividend yield is your yearly yield that the company will pay out to you. Usually it is paid in quarterly segments. So the dividend yield is 1 year and it'll be divided up into 4 payments throughout the year each quarter. And this company does not pay a dividend, so we don't see anything. But usually it would say like 0.6% or 1.2%. Some go up to 3%. If you see a company that has like an 11% dividend yield, avoid that company. Generally speaking, those companies, it's too good to be true. So I would just make sure to avoid those and look for companies that are realistic. But McDonald's, Microsoft, Starbucks, there's some companies that have great dividends out there that you can find if you're interested in creating an income stream there. Now, the 52-week high, we can tell this company was trading as high as $64.86. It's currently trading at $26.82. So it's trading significantly below its 52-week high, which we could see as a good sign that maybe this company really is undervalued right now. However, it's almost 3 times higher than 52-week low, which was $10.42. So either it recovered significantly, and if we go back and look at the history of this company and its stock price, we could tell that during March, it crashed along with the rest of the U.S. economy there and the rest of the U.S. stock markets. And during that crash, it went from, around $64 all the way down to the low of $10.42. It has now recovered to $26.82. So that's a really good sign that the stock price has recovered. Perhaps the company has done well. Then there's a description of this company. It's an aircraft leasing company. They talk about their CEO. I love reading the Wikipedia page, really getting to know the history of this company, its employees, its leadership is, its executive team, which is a really important part of a company. When it was founded as well, who its subsidiaries are, etc. You can really go all out, and it's kind of like being a detective, which is really fun. Anyways, let's move on here. The next thing I'm going to do is I go to investor relations. Now, the investor relations of this company is simply a summary of all its financial reports, all the filings it does with the SEC. If you want to get information as well, such as its quarterly results, you can go to the investor relations, or you can go directly to sec.gov. Well, they'll have all that information as well. Now we're going to look at the most recent Q2 2020 financial results. So what are we looking for in this? Well, we're looking that the assets are greater than the liabilities, that revenue is growing, net income is growing, cash on hand and short-term investments are growing, expenses are shrinking. So this kind of depends on the company, though. Some companies, maybe they're currently growing, so they're spending a ton of money right now and their expenses are growing, but that's just because they're innovating, they're creating new products, whatever. So that can depend a little bit. On top of that, expenses can be growing as revenue grows as well. But we also want to see increasing profit margins, et cetera, et cetera. Now, if you don't know what any of these words mean, if you have no clue what net income means, cash on hand, profit margins, liabilities, go ahead and just do a Google search. You can go to Investopedia and look up all these words, because there's a lot of basics here that you need to know before you even really consider doing an analysis of a company. And in this video, if I were to explain exactly the definition of each one of these words and why they're important, it would take me hours. It doesn't take that long necessarily to do all the research and to find out about it. Just go do a quick video. You can pause this video, do a quick Google search. There's some really great books out there that'll explain this stuff to you super simply. But let's move on here. So then we go ahead and we start off reading their Q2 2020, their financial report, quarterly report. And the reason I do the most recent quarterly report is because it's really how the company is doing right now. Sometimes it'll be a couple months ago, but it's the most recent data that we have on this company, most recent public data. And so I really like to know how the company is doing currently. And they gave a lot of guidance for how what they guess the future is going to be like. They gave financial statements, income statements, balance sheets, etc. So there's a lot of information here that you can use to research this company. The only issue with the quarterly report here is the timeline of it does not go back super far. So perhaps they had one bad quarter here. And by reading this, you might think this company's trash. But if you look 5 years before this quarterly report, well, it's actually grown significantly. Maybe it seems like a bad quarterly quarter, but compared to last quarter or compared to a quarter a year ago, it's actually done really well. So that's one thing to consider here. Now, there's a bunch of different highlights here that they go over. They highlight a bunch of the best things. about this company. So they said that they have approximately $12 billion in liquidity. They raised $3 billion in the second quarter. They have approximately $27 billion in unencumbered assets, which is really good. So remember, this is a near almost $2.5 billion company. The fact they have $27 billion in unencumbered assets is pretty incredible there. It's significantly greater than their market cap. An adjusted debt to equity ratio 2.5 to 1. Now, usually 1 to 1.5 is a pretty good debt to equity ratio, but for businesses like this or mining companies, companies that just take on a lot of debt, a lot of construction companies as well, 2.5 is a fine debt to equity ratio. On top of that, they have 59% of their fleet are new technology aircraft, etc. The average lease expires in 2027, which is a great sign as well that all their leases aren't expiring super soon, since we know the airlines are currently struggling a little bit. Now we could go on in depth. They have a big little spiel here about the current situation that they're in, and I'm not going to read all this since this video is for beginners. If you want to read this, I have some more in-depth videos about this company, but we got to keep going on here. Then we look at the total revenues and other income. We can see that it basically stayed the same. It actually decreased by 2%. One really important thing to look at is what the dollar amount is for these numbers here. So it's US dollars in millions, which means that 2,436 number, well, that's actually $2 billion, 436 million, not just $2,000 and 436. That's that would be pretty shameful for a $3 billion company. Anyways, let's keep moving on here. And that whole thing I highlighted in yellow there, it's just a big description of how their revenue is doing. But because their revenue didn't decrease significantly, it kind of just stayed stagnant, at least for 6 months ended. And I like to look at 6 months ended a little more than 3 months ended. 6 months ended is double the length of time, and it just gives me a better picture of how the company is doing in a more long-term standpoint there. Let's move on here. So revenues and other income, we can see, sorry, the numbers are really small to read here. It decreased slightly. We see total expenses increase slightly. So it's a little bit worrying here from what I said earlier, what we should look for. Net income also decreased a little bit. But again, this isn't the biggest deal, because if you look at the history of this company in the past, if you look at the past few quarters or past 5-10 quarters, well, it's actually growing pretty significantly. It's just that this quarter was a little stagnant because they were recovering from the crash and from the whole situation that was going on in this crazy quarter. Let's keep moving on here. So then we see their cash and cash on hand here. They have about $2.6 billion on hand, which is pretty incredible. They have $970 million in 2019. So that's a huge increase in the amount of just cash they have on hand. That's pretty incredible, and that's really what you like to see there. Total assets are $45 billion, with total liabilities only at $35 billion US dollars. So now I want to do something. And actually, before I do that, I'm going to go ahead and look at the long-term timeline here. So this is from 2006 to 2020. And remember how I was saying the quarterly report gives you the information currently, but it doesn't always give you the history. Well, this website here is called macrotrends.com. Some other great research websites are hypercharts.co, Yahoo Finance, and just the SEC website, sec.gov. And you can tell here that its long-term debt has increased pretty substantially, but its shareholders' equity, what that is, it's your your debt minus your total assets total assets minus total debt. That is your shareholders' equity there. It's kind of the equity left over after subtracting all your debt there. What's increased substantially, which means their total assets are increasing over time, whereas their long-term debt seems to be slightly stagnated right now. That's a great sign for this company. On top of that, their debt-to-equity ratio that we spoke about, well, it's actually decreasing, which is a great sign, because the lower that debt-to-equity ratio becomes, that means they have more assets, their debt is lowered, and they're going to be a much healthier and safer investment to make. Now, they also gave a bunch of their financials year over year. And as I said, although the revenue didn't seem, amazing this quarter, it actually decreased a little bit from last quarter. Well, from 2013 to 2019, they've pretty much quadrupled or, 5 times their amount of revenue that they're doing. And that's a really good sign. It's same with gross profit as well. If we go ahead and look at net income, it's increased a substantial amount over time from 2018 to 2019, 2017 to, not 2017 there, but over the time, especially from 2013 to 2019. So that's a really good sign to see. Same with EBITDA as well, earnings before taxes, depreciation, and amortization, however you say that last word. Sorry, sometimes I fumble my words a little bit. But let's move on here. Now I'm going to do a little quick formula. This is a really famous formula. It's a Benjamin Graham formula for how he traditionally valued companies. He traditionally called this formula, it's also known as a cigar bud formula, because a lot of the companies he would find are kind of like a cigar bud with just a few last puffs on them. But it also works really well for simply valuing a company and then comparing that value to what the company is currently trading at. And it's called the net current asset value per share. What you do, you take your shareholders' equity, which in this case is $9.7 billion just about, which again is your total assets minus total liabilities. And then you take the total outstanding shares, which in this case is 129 million shares, and you do the shareholders' equity divided by the outstanding shares. That gives us a per share price of $74.82 a share. Now, the current share price is around $27 a share, so significantly lower than the net current asset value per share price of $74.82. Now, that means, this is also known as your liquidation value, by the way. This means that it is around 150% plus gain to reach the book value or the liquidation value of this company. So if you had preferred stocks, and preferred stock, what that is, if the company was to go bankrupt and liquidate all its assets, well, you'd be the first one to receive cash for that liquidation. Well, if that were to happen, you'd receive a pretty significant amount of money here, since the current share price is significantly below the net current asset value per share price, which is a great sign and really points to, along with the PE ratio of really low PE ratio of 3, that this company is perhaps undervalued. And the market cap is currently $3.49 billion, with shareholders' equity at $9.7 billion. And they have, $2.3 billion in cash and cash equivalents alone, which is almost, the same size of their whole market cap just in cash. Let's move on here. We'll do a quick summary of AER. So from a fundamental analysis standpoint, from that research standpoint, it's pretty good. We'd like to see a little better revenue growth in the future. They're consistently, I spelled consistently wrong there, little typo. They're consistently beating earnings though. Their net income is growing. Their net current asset value per share is significantly below the current price. Their PE ratio is also incredibly low. What about the social analysis? Well, from a social analysis, airline-related stocks have been seen as a no-go recently to investors because investors are a little worried about the future of the company, so perhaps that's why it's trading so low right now. Luckily, the leases of this company continue to 2027, so even if these, airlines are really struggling, they still have to pay and make this lease payment to AER here. It's an Irish company, and foreign ADRs tend to have low PEs, which that's okay, but 3 is still pretty low. And then technical analysis, well, it wasn't even necessary, as you just saw, for this company whatsoever, and it really wouldn't provide any valuable insight to this company and to this analysis. Now, to finish off this video, here's some simple investing advice that kind of goes along with an analysis of a company. Be greedy when others are fearful, and fearful when others are greedy. When you see people promoting a company, getting really hyped up about it, and you do a fundamental analysis like we did with this company, and then you do a social analysis as well, and something maybe just seems a little off, maybe their products aren't as good as they say they were, or whatever it might be, they're losing money, well, people are just getting greedy there. And you could see it, the share price is skyrocketing when you look at it from a technical analysis standpoint. But be greedy when others are fearful, and fearful when others are greedy. So that would be a time to be fearful. And when others are fearful, saying, I don't really like this company. For example, with AER right now, because it's related to the airline industry, people are being fearful about that. But from the analysis we just did, we could tell the company is incredibly undervalued. So maybe it's a time to be greedy, pick up some shares. Who knows? And I'm not encouraging you to pick up shares of this company. I'm just using it as an example. It's also okay to miss opportunities. You don't need to catch every single one. There's tons of companies that go up 100%, every year or every week, whatever it might be. There's crazy stuff going on in the markets all the time. There's so many public companies. The economy is always moving. It's just a machine going on and on. And it's okay if you miss a few opportunities. You do not need to catch everyone. It's much better to just be patient, do a fundamental analysis, a deep analysis, really get to understand a company like we briefly did with this company, AER today, and then make an investment after doing your research, after doing your fundamental analysis, as well as your social analysis, then going ahead and pulling the trigger. You don't need to jump the gun on anything. It's just some simple investing advice here. Anyways, thanks for watching. Please subscribe. I hope you got something out of this video. Make sure to follow me on Twitter at StockerFinance for more information. And if you want to PM me on there, go ahead. I'll answer all your questions, or you can comment them down below. Make sure to check out these videos as well. They might help you out. And if you want to support this channel, well, patreon.com/StockerFinance. We got some good stuff going on over there. Thanks for watching. Peace out.